All right, welcome to the Explainer. Today, we are going deep, and I mean deep, into the finances of Netflix. And look, you gotta forget everything you thought you knew about the streaming wars, because what's happening right now, it's a true inflection point. The entire story of this company is being rewritten as we speak. So yeah, let's dive right in. And this quote, wow, it just nails the high stakes drama perfectly, doesn't it? On one hand, you've got this incredible financial performance. We're talking $9.5 billion in free cash flow. But on the other hand, they're making this massive bet the farm kind of gamble with the Warner Bros. Deal. So you see, the big question isn't just how many new subs did they get anymore. No, the stakes are way, way higher now. So how in the world did we get here? Well, the story has completely changed. I mean, fundamentally. Netflix isn't just the king of streaming anymore. It has morphed into this sprawling, multifaceted media empire. This isn't just about dropping new seasons of a hit show. It's about building entirely new foundations for the business itself. Okay, so let's break down this new identity. What does it actually look like? Well, the classic subscription model, the one we all know, that's still the core of the business. But now they've layered on these incredibly powerful new pillars. You've got the ad-supported tier, which is turning into a serious revenue machine. Then there's the big push into live events, stuff you can't just binge later. And maybe the biggest piece of all, massive M&A. This signals a super aggressive plan to just consolidate power. All right, let's put on our optimist hat for a minute and look at the bull case. To really get why there's so much excitement around Netflix right now, you have to understand this argument. And the argument is, simply put, that the company has pulled off one of the most incredible operational turnarounds we've seen in a long, long time. And the bulls, they think the momentum is just getting started. This slide just lays out the bull case perfectly. Think of it as an inflection checklist for fiscal year 2025. And look at this. The argument is that Netflix has just systematically gone down the list and checked every single box. Revenue reacceleration? Check. Margin expansion? Check. Free cash flow on a massive scale? You bet. Check. A fundamental shift in the business model? Check. The only box left unticked is repairing the balance sheet, and that's only because they're about to make their next huge move. Okay, first proof point. Let's start at the top line, revenue. After all that talk and fear about a slowdown, what happened? Revenue growth re-accelerated to 16% in fiscal year 2025. And you gotta understand, this isn't some small bump. This is a clear signal that the growth engine is absolutely firing on all cylinders again. And this next number, it shows that all that growth is incredibly profitable. We're talking an operating margin of 29.5%. In the cutthroat world of media, that is an absolutely elite number. And they're not stopping there. They're actually targeting 31.5% for next year. That just screams pricing power and some seriously slick operational efficiency. But here it is. This is the number that really changes the entire story. $9.5 billion in free cash flow. Look, this isn't just some accounting profit on paper. This is cold hard cash. And that cash is what transforms the whole narrative. Netflix is no longer that company burning billions on content. No, it's a cash-generating machine. This is the war chest that makes a crazy big move like buying Warner Bros. Even possible. And the bulls will tell you this momentum isn't some lucky break. It's built on brand new structural growth drivers. The ad tier, it's an absolute rocket ship. And they're projecting it'll double its revenue next year. Live events like the NFL, that's bringing in a whole new audience. And yeah, even the stock split plays a part, making it easier for more people to own a piece of the company. These are long-term, sustainable engines for growth. Okay, now we get to the big one, the move that the bulls believe basically cements Netflix's dominance for the next decade. We're talking about the acquisition of Warner Bros. Discovery. And you have to understand, this isn't just about buying more shows. This is about buying an entire kingdom. I mean, just think about the assets this deal brings under one roof. You get HBO and HBO Max. You get the legendary Warner Brothers film and TV studios. You get the entire DC Comics universe. This creates what you can only describe as an intellectual property fortress, one that is simply unassailable. I mean, what competitor can possibly match this kind of scale? This gives Netflix what could be unprecedented pricing power for years and years to come. But of course, there is always another side to the story. For every bull, there's a bear. And right now, their case is just as compelling. They look at this grand vision and they don't see a checkmate. They see a really dangerous, debt-fueled gamble that could put the whole company at risk. And for the bears, it all starts with this one giant number, $42.2 billion. That's the size of the bridge loan needed to make this all-cash deal for Warner Bros. Discovery happen. That is just a staggering amount of debt to take on. I don't care how big your company is. And that debt, it has immediate real-world consequences. The company's very popular share buyback program, it's on hold, indefinitely. And why is that? Because every single spare dollar now has to be funneled towards paying down this mountain of debt. Deleveraging, just paying off that debt, becomes the #1 priority, and it constrains every other financial decision the company might want to make. So this slide really puts the two sides in direct conflict, right? The bulls see the promise, unmatched scale, long-term pricing power, but the bears, they see the peril. They are seriously worried about the massive operational challenge of integrating a legacy studio like Warner Bros. You're talking about a completely different culture, different systems, all while the company's finances are under extreme stress. Mergers of this size are notoriously difficult to pull off. And here, right here, is the crux of the bear argument. The stock is trading at roughly 34 times its trailing earnings. Now, that is a premium valuation. It essentially prices in perfection. It assumes that absolutely everything is going to go right. At a price like that, there is zero room for error. Any little stumble, whether it's in the integration or with the ad business, could cause a major correction in the stock price.
Which brings us to probably the single most important concept for Netflix right now: execution risk. It's the risk that a brilliant strategy on paper completely falls apart in the real world. For the bulls, the path forward is clear. But for the bears, it's like watching someone walk a tightrope with no safety net. And here's the real takeaway. Successful execution, it's no longer just an option for more upside. It's now a requirement just to justify the current stock price.
So where does all this leave us? Well, what's interesting is that both the bulls and the bears are actually starting to agree on one really big thing. The entire debate has changed. The old Netflix story, it's over, done. And this is the new consensus conclusion. Netflix has grown up. It's not a pure growth stock anymore, judged solely by how many subscribers it adds each quarter. It's now a complex, mature media conglomerate, and it has to be judged by a completely different and frankly tougher set of metrics. So the new narrative, the story for the next few years, it's all about execution on these three critical fronts. Number one, can they actually integrate Warner Bros. Discovery successfully without destroying a ton of value in the process? 2, can they really scale that ad business to the massive heights they've been promising? And 3, can they show the market they have the capital discipline to pay down all that debt and fix the balance sheet? These are the new questions that matter. Everything else is just noise. And all of this leaves us with one final, absolutely critical question for the next 12 months. Will Netflix execute flawlessly and see its value compound, grow from here? Or will it stumble under the massive weight of this debt and all the integration challenges, causing the market to reevaluate its worth? Downwards? A process Wall Street calls derating. The answer to that question is going to define the entire next chapter for Netflix.